Have you ever considered purchasing a baseball team? My name's Matt, and I'm a current strategy and operations associate at Google. Prior to that, was a management consultant at BCG, and today I am going to walk you through how I would solve a Bain and Company case interview question. But with that, let's get right into it. All right, so the question reads as follows. Our client, Alpha Capital, is a private equity firm that is considering buying the Philadelphia Phillies. The current team owners approached Alpha about purchasing the team for $1.1 billion. Alpha engaged our firm in the due diligence process and wants us to help them understand A, what is the team worth, and B, should they make this investment? Okay, so the first thing you want to do whenever you're given this kind of a question is you want to take quick notes. Now there's two questions at play here. The first is, what is this team worth? And the second is, should Alpha Capital invest? Now these are similar questions, but they're not exactly the same. And so it's important to understand the distinction between asking what the value of this team is versus whether or not they should invest. Because valuation is only one aspect that goes into the decision-making process of whether or not you should invest in a particular company, or in this case, a sports team. And the answer to this question is going to inform this question, but it won't necessarily be the only thing that we consider when we answer this question. And so the first thing you always want to do in a case interview is, after you've taken notes on the prompt, you want to think through a couple clarifying questions that you can ask your interviewer. Now, the reason why you want to ask clarifying questions is because, one, it solidifies your own understanding of the situation and makes sure that you're not missing out on any important details. And two, it gives you an opportunity to demonstrate that you're thoughtful and thinking ahead. And so I'm just going to brainstorm a few key questions here that hypothetically you could ask. These are not the only questions you could ask. There's technically an unlimited number, but you want to come up with usually at least 2 or 3. Okay, so I've taken a few minutes to put together a few clarifying questions, and I'll just walk you through each of these now. So the first question is, what is Alpha Capital's investment strategy? Now, I know this might seem a little bit basic to be asking, but it's actually a really important question for us to understand, because we know that Alpha Capital is a private equity firm, but we don't know what their specific investment strategy or mandate is. And when I say investment strategy, I'm saying, what types of companies or teams do they invest in? Do they traditionally invest in sports teams? What is their typical investment horizon? Do they like to typically buy a business, operate it and improve it for 5 years and then sell it? Or are they more of a long-term investor and they like to hold their investments for 5+ years? Also, what is the typical way in which they fund their investments? Just because the purchase price is expected to be $1.1 billion doesn't mean that that entire $1.1 billion is going to be funded by Alpha Capital. They might be raising debt or outside funds from other investors. My second clarifying question is, does the $1.1 billion purchase price include the team and the stadium, or is it just the team? And this is really important because when we say they want to buy the Philadelphia Phillies, what does this actually mean to us? Does this mean it's just the players, or are we talking about the entire stadium, the seating, the merch, and everything else related to the sports team? I would assume that this $1.1 billion means everything related to the team, but it's good to clarify. Third, what are the major revenue streams? Again, really important question here. How do they make money? What is the business model? I would assume that for a sports team, the major driver of the revenue is going to be through ticket sales. But a lot of sports teams have additional revenue streams as well, including media and streaming royalties, as well as merch sales to fans and other ways of generating additional income from games. And tied to that, what are the major cost drivers of operating a sports team? Again, very important, because in the context of a private equity transaction, profitability is going to be critically important, because in private equity, typically what happens is you put a lot of debt onto the business, or in this case, the sports team, and you need the company to generate enough cash to pay down the debt over time. Now, these are just 4 questions that I've just come up with off the top of my head. Hypothetically, you could come up with a lot of other clarifying questions, but essentially your interviewer will probably give you some information related to each of these. And so the next step from here is you're going to want to go into developing your framework. And the way you want to do this is you want to just say, okay, awesome. Can I just take a few minutes now to put together a framework? And you want to take probably 90 seconds to 2 minutes, no longer than 2 minutes, on coming up with a framework. Now, before I come up with the framework, for those of you who are not familiar, a framework is simply a fancy word for a set of key buckets that you want to investigate related to this problem that we're trying to solve. And it's designed so that you should be able to tick through each bucket and eventually get to a level of confidence where you can make a solid recommendation as to whether or not it's a good idea. And so I'll give you an example here. Okay, so I've just spent a few minutes putting together this framework. Now, the way that I've structured this framework is I've split it into 2 key buckets, and I'll walk you through how I would explain this to an interviewer. So the first thing you want to say is, awesome, so I've taken a few minutes to put together a quick framework, and now I'd like to walk you through it. So there's 2 buckets to this framework. The first is financial considerations related to whether or not we should invest, and the second is non-financial considerations. And so under financial considerations, broadly speaking, there are 4 things that I'm most interested in. The first is valuation / purchase price. I've kind of lumped these into the same bucket here. Really want to understand how much we believe this team is actually worth, and likely we'll need to put together our own analysis to understand the intrinsic value of this team, and compare that, of course, to the purchase price, which we know is 1.1 billion, but that doesn't really mean a whole lot to us without knowing the valuation first. And the second thing is cash flow / profitability. As we know, since Alpha Capital is probably looking to make a positive return on their investment, it would be good to understand how profitable the team has been historically, as well as going forward what we think is reasonable from a cash flow generation perspective. Because again, in a private equity transaction, you're typically going to be putting debt onto the business and using the cash flows of the company to pay down that debt over time. And so it's really important for us to find a company, or in this case a team, with stable cash flows, if that is the route that we are taking. Thirdly, really want to understand sources of funding. And again, as I've said, there's likely going to be some debt that gets put onto this transaction, but it would be good to understand like the proportion of debt to equity. Now, debt is going to be money that they're raising from outside investors, and equity is going to be the portion that Alpha Capital is actually putting in as well into the transaction. And it's good to understand the proportion of debt to equity because it gives us a sense of risk related to the transaction. So if, for example, it's going to be a 70-30 split where 70% is debt and 30% is equity, then I might want to have a conversation with Alpha Capital's MD about, hey, why do we need to put so much debt onto this business? Is it because we simply lack the funds to actually meet the entire 1.1 billion purchase price, or is there some other reason? In most scenarios, it's good to have not too much debt on the business because if things do go south, they can go south very quickly. I'm not going to spend too much time talking about that, but this is why funding is really important, because also where are you going to get it from, right? Like who, where, and how expensive is it going to be? How much is it going to cost us to raise that funding? Fourthly, want to understand any potential synergies. Now, typically synergies are more common when you have a strategic acquirer buying a business, aka one company buying another company, as opposed to a private equity firm buying a company as part of their portfolio. But it's still important to consider because there could be some possible cost savings related to this deal, or at least ways in which the private equity firm can come in and either drive up revenue or lower costs. But moving to the non-financial bucket, here I'm interested in, again, 4 key levers, the first being competition. I want to understand how the Philadelphia Phillies stacks up against the competition in the league. And if we have other competitors that are more successful than us, then what are they doing and what sort of best practices are they doing that potentially we need to watch out for? The second sub-bucket is customer. Now, customer you can really split into a few different groups, but the biggest one most people are thinking of is probably the fans that come to your stadium, but also you could argue that another customer could be like the media companies that are buying the streaming rights to your games, right? They're going to pay you some amount in order to be able to stream your baseball game live. And so with the fans, we have to be really careful too, because how are the fans going to react when they find out that a private equity buyer is coming in and taking ownership of this team? Some of them might get pissed. And also, what do they care about? Maybe there are certain preferences that these fans have that we have to be cognizant of when we're making any sort of changes to the business after we buy it. And moving down to this third bucket, which is the players, again, a lot of the times the value of the team is going to be heavily dependent on the players and if we have a really stacked roster or not. On top of that, the players' salaries are probably one of the biggest expenses that this team has. And so we have to think about things like player attrition, whether or not these players are going to leave when they find out that we are going to be the new owners, and also how much are we paying these players? What are the expectations around potentially signing new player contracts? things like that. There's a whole host of considerations that we have to think about because the team is so heavily dependent on the performance of the players. And finally, with this fourth bucket here, it's kind of a catch-all, but I've just written other growth levers, question mark. So is there anything else on the non-financial side that we can think of? What is part of our plan and what opportunities are there to potentially increase the value of the team and ultimately the value of our investment? And so maybe this is something like increasing the number of merch lines that we have. Maybe this is pursuing sponsorships with influencers to drive more traffic to the games. Maybe this is implementing some kind of dynamic pricing situation to drive up the amount of revenue that we're generating. A bunch of things could fall into this bucket, but any and all growth levers we want to brainstorm and think about so that we can have a good understanding of what the potential upside is here and what the private equity firm can actually do to this team once they purchase it, if they do purchase it. Now, once you do come up with your framework, what you want to do is you want to walk the interviewer through at a high level, basically the same way that I just did here. And they may potentially have some questions for you, but if this is a interviewer-led case, then they will typically point you towards the right direction or a specific bucket that they want you to move towards. And if it's an interviewee-led case, which most Bain cases are, then the onus is kind of on you to suggest a bucket that you would like to dive into first. And so in this scenario, let's say, for example, I'm very curious about the valuation of the sports team, right? Because question number one is, what is this team even worth in the first place? And I think a lot of these other buckets are important, but the number one thing we need to find out first is, how does the valuation compare to the purchase price? And so I would say something along the lines of, well, I think the valuation is really important to understanding whether or not we should even make this investment to begin with. So I'd like to start there. Do we have any information related to the value of the business or any information related to revenue or costs? And in this scenario, the interviewer might press you to think a little bit harder about what the potential sources of revenue might be. And the reason why I'm asking about revenue and costs is because at the end of the day, to get to valuation, we have to understand the cash flow of the business and value the company based on the present value of its future cash flows. For those who haven't taken a corporate finance class, valuation at its core is projecting the future cash flows of the business and discounting those back at a relevant discount rate. And so that's exactly what we're trying to get to here. And so after the interviewer has pushed you to come up with a few different sources of revenue and costs, then they will show you this exhibit, which gives you information related to the revenues, which we can see comes from ticket sales, concessions, merchandise, media rights, and sponsorship/ads, and also information related to the costs, which we can see is player salaries, front office costs, sales and advertising, and stadium/facility costs. Okay, so I've written down a bunch of information here related to two of the major revenue streams. And so we've been given a bunch of information related to ticket sales and concessions. Now, it's important to note here that there's also revenue which is coming from merchandise, media rights, and ads/sponsorships, but we'll get to those in a second. And so your interviewer will basically give you all of this information, and it'll be up to you now to calculate the total revenue per year generated by the baseball stadium. And so just to walk through the math really quickly, we have about 50,000 seats per stadium, of which 90% of those are standard seats. The standard seats typically fill at a 56% fill rate, and they cost $25 per seat. And the remaining 10% of seats in the stadium are actually premium seats, which fill at around 75% per game and cost 4 times as much, $100. And another useful data point here is that there are 80 home games per year. And so we're gonna wanna factor that in when coming up with an annual revenue figure for ticket sales. And so I'll do the math with you right here just to walk you through. So 90% of 50,000 means we're taking 10% off of 50,000. 10% of 50,000 is 5,000. So this we know is 45,000 standard seats in the stadium. Now, only about half of them, though, 56%, are going to be actually filled. And so what I'm actually going to do is I'm going to round this down to 55% because that's a little bit easier to deal with. And so we can take 50% of 45K and we can take 5% of 45K. And so 50% of 45K is roughly 22,000. And 5% of 45K is roughly 2,000 to 3,000. Let's just say 3,000. So that means 25,000. And so if we add that together, we get roughly 25K seats. I'm gonna put an approximation here because that's a round number. And if we multiply 25,000 seats times the $25 per seat rate, then we get around 625K in total sales coming from standard seats. But we still have to calculate the premium seat share, and so about 10% or 5,000 seats are premium seats in the stadium, 5,000 seats, but only 75% of that 5,000 is actually going to be filled. 75% of 5,000 is roughly 3,750, and we multiply that by $100 per ticket to get 375K in ticket sales per game from premium seats. Now I'm going to add the 375 plus the 625, which is $1 million. So $1 million in total revenue by the 80 home games per year, which means the total revenue coming from ticket sales per year is roughly $80 million. Okay, so that's the major revenue stream from ticket sales. Now on the concession side, we have data that's given to us related to the number of fans buying concessions per game, how much they're spending on average, and again, the number of home games, which we know is 80. And so this calculation here is a little bit more simple because we're just multiplying these together. And so 20,000 times 25 is roughly 500,000, and we multiply 500,000 times 80 to get us to 40 million. Okay, so we've calculated the total revenue coming from ticket sales and concessions. And as I mentioned earlier, there are actually 3 additional revenue streams as well. One of those being merch, another being media rights, and then the last one being sponsorships/ads. And so in this problem for merch, we're actually given information that the team sells about 1 million pieces of merch per year at around $50 per piece. And they're going to get a 20% commission on that. Because again, oftentimes merch is created by a third party and it's just sold through the branding that the team has. So we have 1 million pieces times $50 per piece times 20% commission, which gets us to 20% of 50 million, which is 10 million. So $10 million a year is coming from merch. Now for the last 2 revenue streams, we're actually just given these outright basically. And so we know media rights is actually going to be roughly 120 million per year. And then sponsorships and ads is about 50 million per year. And so if we total up all 5 of these revenue streams, what we'll actually get is an aggregate revenue per year of around $300 million, right down there. But we're not done here because again, we're trying to come up with the valuation of the business. And so we've only finished coming up with the annual revenue from the team. And so we still need to find out what the annual costs from the business are. And so you should ask the interviewer if there's any information related to costs as well. And he's actually going to give you, in this case interview scenario, the main costs associated with running this team. And so I've gone ahead and written the costs down here, but essentially player salaries, not surprisingly, are the biggest expense at 110 million. Front office costs are 20 million, sales and advertising of around 50 million, and stadium/facility costs, just to keep the lights on, around 20 million. And so your total cost base is coming out to roughly 200 million per year. And so now, to continue with the valuation, we want to find out what the annual cash flow or the earnings before interest and taxes for this company, for this baseball team is. And so we start with our revenue, and then we take out our costs to get to our pre-tax income, otherwise known as EBIT, earnings before interest and taxes. And then we want to take out our taxes to get to the actual cash flow before interest that we're going to use as part of this valuation. Now, there's one more thing that we need, which is the discount rate, because in order to calculate the value of this baseball team, we need to have the annual cash flows, but we also need to discount the future cash flows back to the present. And so you should go ahead and ask your interviewer, do we have an appropriate discount rate to value this baseball team? And they will go ahead and tell you that 10% is the discount rate. Okay, so now we have enough to start doing the math. And so we have our 300 million in annual revenue here, less our 200 million a year in costs, which means our annual EBIT is going to be, just gonna erase this, 100 million. Now the tax rate, we should also clarify. You can usually ask your interviewer something along the lines of, should I assume, or can I assume a 20% tax rate? In this scenario, actually, they're going to tell you to assume 0 taxes for the purpose of simplicity. This is not super realistic, but let's just go with it. It makes the math one step easier. And so assuming that our annual cash flow is around 100 million per year, and we are discounting this back as if it is a perpetuity, meaning that each year into infinity, we assume that it's going to continue to generate 100 million per year. That means all we need to do is we need to divide 100 million by 10%, which is simply 1 billion. Okay, so our valuation for this baseball team right now is 1 billion. Now, the first thing you should do after you do all of this math is you should immediately step back and think to yourself, what does this number actually mean in the context of this case interview? Because a number by itself means nothing unless it can be compared to another relevant metric or another data point, right? A discrete data point means very little when it is looked at in isolation. And so if we compare the 1 billion valuation to this 1.1 billion purchase price, immediately what you might notice is we're starting to wonder, does this make sense then? Because we're going to be spending more money to buy this team than what it is currently worth. And you should try to have a discussion with your interviewer at this point and let him or her know what is going through your head. You should talk aloud and say something along the lines of, well, okay, this is really interesting. So it sounds like we have a valuation number now of about 1 billion. But when I look at that in relation to the purchase price that was proposed earlier in this case of 1.1 billion, it looks like we're short of about $100,000. Now, my initial gut instinct is that this makes me question whether or not this investment is even worth it. But at the same time, there may be other factors to consider that would still make this a potentially good investment for Alpha Capital, including one of the other buckets in my framework, which was synergies. We haven't really talked about the fact that even though the valuation right now is 1 billion, maybe there are a number of levers and a number of things that Alpha Capital can do to increase the valuation of the business beyond that 1.1 billion purchase price in year 0. And this valuation number was calculated using historical numbers. And so again, this is simply assuming that Alpha Capital bought this company and then did absolutely nothing to change the revenue growth or the cost profile of the baseball team, which is highly, highly unlikely. And so a good candidate will notice this immediately and not just take the analysis at face value, because oftentimes there's a second order insight underneath the initial observation of, hey, it looks like the valuation is actually less than the purchase price. And so after you bring that up with the interviewer should actually show you a number of additional exhibits related to the potential synergies from this transaction. And so what we can see here is actually there is a chart on the left-hand side showing the potential boost to total revenues based on 4 different levers that the owner of the baseball team has to drive revenue up. We have dynamic ticket pricing, renegotiated local media deals, attract higher value sponsors, and revamped concessions offerings. And then on the right-hand side, we have actually a team cost comparison benchmarking our costs to the league average. Now, in a case interview scenario, again, you want to walk the interviewer through your thought process and basically talk aloud like how I just did to you. And you want to first talk about what observations you notice from the charts. And as you talk through it, this is going to help you start to think about some initial insights that might be interesting to dig into. And so you can say something again along the lines of, hey, so this is really fascinating. It looks like we have a lot of different levers here to boost total revenues. It looks like dynamic ticket pricing is going to have the highest impact right now by increasing revenues by 4%. And on the right-hand side, I can see that we have a team cost comparison. Actually, I can see that our team's costs are higher on average than the league benchmark. So it looks like there's some room actually to bring down some of these costs, including our sales and advertising costs. And so if you've been following along at this point, you probably know where we're headed next, which is to calculate an actual number based on these new data points. And so we want to come up with the additional revenue and the additional cost savings associated with implementing all of these potential revenue levers and also bringing down our costs to the league benchmark. Because in theory, a private equity firm with majority control over this baseball team should be able to make all of these changes within reason. Really running out of whiteboard space here, but I'm going to put synergies right here, okay? And so first let's calculate the impact to revenue, and then we can calculate the impact to our costs. So it looks like based on the analysis, we have 4 levers here. Dynamic ticket pricing increases it by about 4%. Renegotiated local media deals increases revenue by about 3%. And attracting higher value sponsors increases by 2%. And revamped concessions offerings is going to increase by 1%. And so if we just add all of these up together, that's in theory a 10% increase to the top line. And so if you remember, top line revenue was around $300 million as we calculated earlier in this case. And so an incremental 10% on top of that would be an incremental $30 million. And so I'm just going to write here increase plus 30 million. And on the cost savings side, we can actually see that it looks like the one cost bucket where we're above the league benchmark is our sales and advertising costs. And it looks like we can bring our sales and advertising costs down from where it's at right now, which is about 50 million if we remembered, to 40 million, which is about a $10 million cost saving opportunity. And so I'm just going to write down minus 10 million in costs right down here in synergies. And so in order to calculate the impact on valuation that these synergies are going to have, again, we're going to take our incremental revenue of 30 million less our 10 million of cost savings, which is an incremental $20 million. Now, how does this $20 million from synergies impact our valuation? Well, we need to discount this 20 million back by 10% again, so 20 million divided by 10%, which is going to get us $200 million impact. And so now if we add this 200 million to the 1 billion, our new valuation is actually, I don't even know if you can see this down here, but our new valuation is actually $1.2 billion with the synergies factored in. But now this is really interesting because with the synergies factored in, we can see that the valuation has finally exceeded the $1.1 billion purchase price. Now, albeit not by a lot, but it's still significant because now this tells a different story. Now, at this stage in the case, the interviewer will probably ask you what your thoughts are, having done all of this analysis, on whether or not Alpha Capital should make this investment. And this is where it's important to go back to our framework and to recall that the financial considerations are very important, but we have yet to consider any of the non-financial considerations. And so it's important to have a discussion with your interviewer about, look, based on the numbers, it looks like the valuation is now higher than the purchase price, which is great news, but at the same time, there's still a lot of additional diligence that we need to do to better understand this baseball team, and specifically some of the non-financial factors that I mentioned earlier on in this case. Because at the end of the day, it doesn't matter that we have a $1.2 billion valuation if, for example, implementing this new ownership and putting all these changes into the business is going to dramatically, say, impact our fan base and a bunch of people stop coming to our games. Or, for example, if we can't even execute some of the growth levers that would drive up revenue or bring down our costs. Numbers and big financial models don't really mean much if you cannot actually execute on the plan. And so the operational component of this is actually really, really important to consider as well. Now, I could go on and on about the different factors that we need to consider, but in a case interview scenario, after a bit of discussion about what other factors you should consider, the interviewer will ask you to close the case with synthesis and basically take everything that you've learned today and bundle it up into a recommendation for the CEO, or in this case, your client, which is a managing director at Alpha Capital. And so a typical way that this is asked is the interviewer will say, hey, so in about 30 seconds, the MD of Alpha Capital is going to come through the door into the conference room where we're working, and he's going to ask you for a recommendation and an answer essentially to the two questions that he posed at the beginning of this project. Now, what would you tell him? And that is your cue to take 30 seconds, just say, awesome, I'm going to take about 30 seconds to put together a recommendation. And take 30 seconds and think through what you want to recommend to the interviewer. Now, it's important to understand that in a case interview scenario, the actual recommendation that you make is less important than the way in which you deliver the recommendation and whether or not you back the recommendation up with data points from your analysis. But just to help you out, a common structure that I like to follow with the synthesis is recommendation, risks, and next steps. Boom. And so if you follow this structure, you'll start first with your recommendation, then you'll talk about some potential risks, and then you'll talk about next steps. And the point of this is that bringing up risks demonstrates that you're thoughtful about what you're saying and you're not just blindly assuming that whatever you recommended is the best path, and instead that you're aware that, yes, things could go wrong. And the third piece of this is where you can demonstrate thinking about ways in which we can get more comfortable with these risks, or ways in which we can learn a little bit more about something to get more comfortable and understand how risky something actually is. And so to give you an example of how I might deliver this recommendation, I would say something along the lines of, awesome, so thanks for joining us today. As you know, we've been doing a lot of work on understanding the Philadelphia Phillies and whether or not this is a good investment. And so although our initial analysis yielded a $1 billion valuation, which was lower than the $1.1 billion purchase price, after some further review on the potential revenue and cost levers that we have, our expected valuation is actually around $1.2 billion, which exceeds that purchase price. Now, that said, there are a number of risks associated with the success of this investment, namely around the execution of actually implementing these revenue and cost synergies, and also with the fan base and how they're going to react to new ownership. Now, what we would recommend as next steps is to get more comfortable with these unknowns is to do some more market research on our customer base and to understand their general thoughts and perceptions on this kind of a change, as well as to look further and potentially speak with current management to better understand the feasibility of implementing things like dynamic ticket pricing or lowering our sales and advertising costs to the league benchmark. I hope that this was helpful, and if you have any questions, feel free to leave them in the comment section below, and I'll see you guys in the next one. Peace.